So here's the big picture for you guys. I think you can now see this.
Yep.
Yep.
Perfect. So yesterday, despite the volatility we saw in the market, we've done something we haven't done very often, which is we now put two price targets out there for the market. We adjusted our 2024 number to 6,100. We were 5,800. And we also laid out a 2025 target of 6,600. So about 12% higher from where we were trading at just on Tuesday, Wednesday. So from our perspective, I think what a lot of people are missing and how they should be trading this, and I know you're talking more short term, but if you're talking about shorter term trading, you really want to put it into the context of the longer term trend of the market. And the longer term trend of the market is you are in the early part of the third year of a bull market off of those October 22 lows. And I think what investors and traders now have to do is sort of size up the opportunity from here. There's a lot of negativity. There's a lot of pessimism out there. But from all the work that we have done, I will just tell you that this bull market is only 507 trading days old. And the typical bull market has lasted, the median has been about 979 days. So again, if you put this into kind of a little spaghetti looking chart that looks like this, I mean, we are still relatively new in the big picture side of things. And I'll just tell you from a pessimism standpoint, I just keep hearing a lot of negativity, like, oh, this market can't work, and this with the economy, and this with jobs and everything else. I just remind everybody that the old Wall Street adage, bull markets climb a wall of worry, and they usually are born on pessimism and they die on euphoria. There's another historic quote for all of us. And at this point in time, there is no euphoria. I've asked every institutional investor that I know since publishing this piece. And again, nobody's like, yeah, we're not in euphoria. We're nowhere close to euphoria. No. And then you break down the technical indicators, and our new highs indicators, our 40-week, they all still remain constructive. And then this gentleman that sits behind me, Mr. Ralph Acapora on the wall, instead of having, the elf on the shelf, we got Ralph on the wall here. But what he'll
the Ralph on the shelf. The Ralph on the shelf.
You can have that. But what it ultimately comes down to, though, is the only way to change this pessimism is through new highs. That's the only way to change it. And that's from a veteran who's done this for a very, very long time. And when you come down and you look at right now what it looks like, this is sort of your cumulative record thinking about the number of new highs. And the new highs are going to lead to more new highs. And then, Joel, you're very focused on election. I know you are. And what I'll tell you is win or lose, depending on, Republicans, Democrats, or anything else, what the mix is, any of these things. Let's just boil it down to history. And history will tell you that since every election since basically 1928, your median return election day to year end has been 1.78%. Okay? 1.78% positive. And I'd also tell you that if it's a Republican win, you're typically higher 67% of the time with a median return of 3.95%. If it's a Democratic win, again, this is just math, you're higher 54% of the time with a median return of 0.57%. Take it one step further between the S&P, that's what I was calculating, and do the same math on the Russell 2000. 82% of the time, you see the Russell 2000 outperform the S&P 500 in that window of time. So as traders are looking to set up their stuff coming into that election, I think you want to be leaning long, not short, okay? Because history says that in that window of time, markets typically go higher.